Honestly, I don't even know where to start with the bad news today. Should we start with geopolitical tensions? Or should we start with 10-year treasury yields back above 4% and the inversion of the yield curve, which uninverted about 22 basis points, which is now inverted again? Or do we talk about the over 3% rise in oil markets today? Or perhaps the scariest of all, the VIX, up to 21 at the time of recording this video. At the same time, the S&P 500 is less than 1% off of all-time highs. This is screaming something at you that you need to know. So first and foremost, I will start with something that is critical for you to understand. With the election coming near, with the fear-mongers that are going to come out and stress the importance of the election, I'm here to spoil the news. The election is not even close to the main event for markets right now. Of order of importance, there are 4 different things that are affecting markets right now and will become bigger issues to markets as we progress throughout this week. Number 1, and the most important factor for whether or not stocks go higher or lower, is Q3 earnings season. That's number 1. That's top of the bar. Number 2 is economic data / inflation. Okay, the two kind of go hand in hand. If the economy's weakening, even if earnings come in good, Wall Street might start to say, how long are earnings going to be good? I don't want to get too nuanced there, but earnings and economic activity tend to kind of go hand in hand, but we'll put them as 2 separate catalysts. So you got earnings, then you got economic data. Number 3, it's a tricky one. You have geopolitical tensions. Now, geopolitical tensions are usually buying opportunities. Well, we're getting some news today that I will share with you in just a moment that the Israeli attack on Iran is imminent, that it could be coming today, which, yes, it is October 7th. There is the historical precedent around October 7th, so we'll see what happens. Here's the deal. This could be a utter black swan event, or this could be not really an event at all. And that's why I put it number 3. It could be the most important thing, but if it's just a strike on Iran's military capabilities, then I think it's number 3. Then I think it's really not that big of a deal. But yes, the tensions will continue to be there. This will still have somewhat of an upside of pressure on energy markets. This could be the most important factor for the markets and really a black swan event if Israel damages or inhibits Iran's oil production capabilities. Why this could be a black swan event is because oil could spike anywhere between $100 to $200 a barrel. Let's put this into context. Moody's even just said 2 days ago that if the price of oil gets to $85 or $90 a barrel, that could cause real economic, uncertainty or pain in the U.S. economy, and that could become a real problem. Let alone if we go over $100 a barrel, or God forbid, $200 a barrel, which would by far be the highest oil has ever reached. Now, in that scenario of oil going anywhere between 120 and 200, you're pretty much guaranteeing a recession because oil affects everything and everyone. If you drive a car, it affects you. If you buy anything at stores, it affects you. 1, because you got to drive to the store, but 2, because companies have to take their products from their facilities to maybe a distributing warehouse, then to stores, right? There's a whole chain of things that are affected by energy costs. And typically when economies are already weak and you see big spikes in oil, it doesn't tend to be good for the economy. And just again, for a little bit of context, back in 2022, oil hit $120 per barrel. And that did have a pretty dramatic effect on even slowing the economy down at that point. Now, people had more savings, people were in less credit card debt, there were other different more positive, favorable factors that were at play in 2022. Fast forward to almost 2025, that would be a huge economic problem if energy were to rally. Now, I think even just an attack on Iran's military infrastructure will still have lingering uncertainties, because it sounds like Iran's going to attack back, and then does Israel eventually attack Iran's oil capabilities? That's a possibility. So I don't think the upside pressure on oil is really going anywhere anytime soon. Question is, when does the attack happen? What does Israel target? And how immediate could a spike in oil actually be? And that's why I put it at number 3, because we've seen Biden come out and urge restraint against attacking Iran's oil capabilities, because of the financial damage that would cause really to the world, but to the US economy mainly. So again, I don't think Israel is going to target Iran's oil capabilities, because that would really piss off the United States, but it is a possibility, so I have to put it as the 3rd catalyst on this list of magnitude of importance. The last one is the election. The election is like the last thing we should be concerned with as investors in this market. Unless there is a sweep on either side, not much is going to get done. It's going to be a gridlocked situation again, and nothing's really going to change. Now, I think what's different this election cycle compared to others is this time we have other things going on. Like, the main focus is not the election. The main focus is all of these other things that I just mentioned. So are we really going to react too much to the election itself? Probably not. I think it's very well priced in what could happen to the economy, what corporate taxes would do, or just raising taxes, lowering taxes. Like, there's so many different nuances. I don't think the markets really care about the election this year. I know that's kind of weird to hear someone say it, but I think it's about earnings. I think it's about the economy. I think it's, yes, about the Fed as well. You can put that in there. I think it's about Israel, Iran, geopolitical problems, energy markets. I think it's much less about the Fed than a lot of people think. So that works both ways, because normally after an election, you tend to rally. And before the election, you tend to kind of sell off or get a correction. With that said, I don't think you need to see an election correction. I also don't think you need to see a aggressive rally after the election, because it's just not that big of a deal. Like, who cares who's in the White House? Do you think that uncertainty being alleviated really trumps a, no pun intended, a good or bad Q3 earnings season, good or bad economic data that comes out in November? What happens with energy markets? Like, is the election more important than those things? Absolutely not, from an investor perspective. Whew. Okay, so I'm glad we're all on the same page. The election is not a big deal. Okay, now let's really break down some of the major events that are happening today. Now, the first thing that I really want to stress to you guys is what's going on in our markets. Okay, think about this in the grand scope of what you've heard since the Fed cut rates 50 basis points on September 18th. Goldman Sachs just a couple of days ago raised their 12-month price target on the S&P by 6,300. Bank of America said they're afraid that their 6,000 price target on the SPX, which is about 600 on the SPY, by the end of this year is too low, that the markets may overshoot that. At the same time, these fuckers, they're positioning for the downside. They're not bullish. Their words are bullish, but forget that. What's the VIX doing? The VIX is at 21.09. It's up 10% today. There's nothing really happening. Okay, nothing. There's some comments from Israel, the Middle East. We'll look at that in just a moment. But just besides geopolitical problems, which we've known about, there's nothing going on today. But yet the VIX is surging. Okay, it gets even weirder. You can see CNN's Fear and Greed Index. It's sitting at 73. Which was the same as where we were on Friday. Yes, the S&P is down somewhere around 0.5%, 1%, 1/3 depending on where markets close. You're still seeing these bullish readings in markets, but yet the VIX is at 21. Now, I understand a lot of people don't understand the VIX. Now, what the VIX is, it is the volatility index. So what happens when the VIX goes up, like it has been since really, what was this, the end of September, really the start of October? What happens when the VIX goes up is hedge funds, institutions, retail investors, but mainly hedge funds and institutions move the VIX. They go out and they're buying more puts than calls. That's number one. So there's more puts being bought than calls. But they're also willing to pay more for puts than calls. So think about this. I'll explain this as simply as possible. If you have a 5% out the money call on the S&P and a 5% out the money put on the S&P, hedge funds are willing to pay more for the put. So for an example, you may have a 5% out the money S&P call that expires in a month that is going for $100, okay? You may have a 5% out the money put expiring the same expiration going for $150, meaning Wall Street is willing to pay more for downside protection than upside protection. And just the bottom line, what this means, Wall Street's not concerned about missing the upside. Wall Street's concerned about not being hedged for the downside. In simpler terms, the markets have limited upside from what the hedge funds and institutions are doing and how they're positioning, and there's more downside risk. That is vastly different than what you are hearing from Wall Street. Wall Street wants to paint this picture to everyone that things are perfect, that there's this asymmetrical risk between missing the upside and downside. Meaning that, again, Goldman Sachs, Bank of America, all these price target increases, stressing the importance of being allocated to markets. Still, as you're near all-time highs, and there's almost 20% S&P 500 earnings growth priced in for next year. But their actions are doing the opposite. Their actions are actually buying puts. Their actions are actually raising cash, being less allocated to stocks. One of the reasons I've explained why this could be happening is it tends to happen like this every time. Before the dot-com bubble, before the 2008 Great Financial Crisis, as investing has become more popularized. Right before a crisis, you tend to see everyone very bullish. Why? Well, if you're a fund manager on Wall Street that, say, makes 2% as a management fee, you don't want to go out and start scaring your clients. Even if you know something bad could possibly happen. You don't want to scare your clients because they're not going to put their money with you. They're not going to invest more, and you're going to make less as a fund manager on Wall Street. So why would you tell people the house is about to collapse before it collapses and make less for yourself? You wouldn't do that if you're the average guy on Wall Street. And I think that's part of what's going on right now. I personally don't know what's going to happen, but I can tell you definitively with the VIX at over 21 on a Monday, just Joe Schmo Monday with not much going on, is telling you something is about to happen. One thing I've learned with almost my 10 years of investing in markets right now is talk is cheap, money's expensive. You want to listen to the money. What is money doing? Where is money going? I don't give a rat's ass what people say. What's their money doing? And the money is bearish. The money is trying to protect their portfolios. There's a big gap here between what we're hearing and what the money is doing. And that disconnect should have you a little concerned at this point. Again, with the VIX going up 10%, when we're really not getting any news today. Now, the news that came out a couple of hours ago says this: according to senior U.S. officials, the Israeli retaliatory strike against Iran for last week's ballistic missile attack is believed to be imminent. Now, this could explain some of the rise in the VIX, but it's kind of rare to see the VIX just continue to go up, oil continue to go up, and nothing happen. Now, you can explain oil's rise, which oil is rising here today, about 3.5% last I checked. Yeah, 3.55%. You can explain that with the Middle East situation, But the VIX continuing to go up, I don't think is justified solely based on the Middle East situation. Now, another big issue today, and something that should really raise some red flags, is the 10-year Treasury, which is back above 4%, currently trading at about 4.02%, up almost 4 basis points again today with like zero news. This is either occurring because Wall Street really believes the soft landing is coming and the Fed won't need to cut as aggressive, or Wall Street is raising 10-year Treasury yields because they are concerned about inflation, which none of it really makes any sense, because if we're not really expecting Israel is going to attack the oil fields, then we're not really expecting an oil price shock to derail the soft landing. So soft landing narrative seems to be the most widely spread view on Wall Street. So I don't think that should be boosting up 10-year Treasury yields. And Goldman Sachs came out just today and said, quote, "We expect a 0.10% increase in September headline CPI, a year-over-year rate of 2.27%. We see further disinflation in the auto, housing, rental, and labor markets, though we expect offsets from catch-up inflation in healthcare and car insurance." So basically saying they expect to see continued disinflation in these areas. So like, they're not concerned about inflation. So again, why are Treasury yields going higher? It's really, it doesn't make much sense. Walter Bloomberg on X posted this. It says, "Fed considered likely to speed up cutting after November. A 20 basis point cut by the Fed next month, quote, remains a good bet," Pantheon Samuel Tomes says in a note, adding that labor data will force a faster pace thereafter. Tomes is suspicious about Friday's much higher than expected payrolls report. Quote, "The scope for another downward revision to payrolls is high, given the low response rate in September," he says. Potentially, this could just be one big market fake out where maybe some soft landing commentary or opinions are pushing up 10-year Treasury yields, but in the grand scope of things, maybe the labor market is not as strong as we think. I don't know. There's not really anything that makes a whole lot of sense to explain this. So I would love your thoughts on this down below in the comment section. So in the news today, Ed Yardeni sees the Fed pausing rate cuts for 2024 after last week's jobs report, which could indicate a potential Fed policy error, because that jobs report was really not as strong as it appeared, with the 753,000 rise in government jobs, which were really just teachers going back to work in August. Now, also potentially affecting markets today, Polymarket's prediction markets now show Donald Trump nearly 9 percentage points ahead of Kamala Harris. This is nearly his largest lead since Kamala Harris entered the election, which this is more interesting than actual polls. Why? Because polls tend to just be polls. This actually has real money on the line. And that's why, to some degree, it's probably more accurate. But then again, that really doesn't make too much sense either. Why would that be causing 10-year Treasury yields to rise again? Perhaps, presumably, Trump would cause more inflation and not allow the Fed to cut rates as much. Like that doesn't make sense. I mean, you'd probably see lower inflation under a Republican president, because that would be less government spending, which would lower inflation. Like, the whole thing around rates and the VIX today and the markets just doesn't make a whole lot of sense. We do have some events later this week. You get Q3 earnings that really kicks off full steam ahead on Friday, with JP Morgan, Wells Fargo, some other banks starting to report earnings. Later in this week, we get the FOMC minutes on Wednesday. We get the initial jobless claims on Thursday, as well as CPI. So really, in conclusion, I don't know what's coming next, but the VIX itself is screaming, we have a major problem. And that's really just Wall Street rushing to buy downside put protection. Now, ultimately, anything can happen in markets. We could get an Israeli response to Iran's attack last week, and maybe the VIX falls, people stop panicking as much, or maybe it's really foreshadowing more weakness to come in markets. I think either way, with stocks almost at all-time highs still, you may be mispriced for downside risk. I think the real concern should be a potential correction in the coming weeks. I think that's what the VIX is stressing, which again is a far contrast to what Wall Street is saying. And it really doesn't make a whole lot of sense. 10-year treasury yields really don't make a whole lot of sense either. With the presuming soft landing, lower inflation, shouldn't that still allow the Fed to remain on their path they've let out in the SEP? Yeah, it probably should. We're expecting by September of next year, of 2025, the federal funds rate is going to be at 3.5%. I mean, why would 10-year treasury yields be rising on that? Potentially, we're expecting more inflation over the next 10 years. That could explain that. But usually, treasury markets are not that forward-looking. Like, usually we're not looking out 5+ years at what the inflation picture might look like and pricing in 10-year treasury yields today based on that. I know it gets complicated when you're talking about longer duration yields and the yield curve as a whole. But just take this away from this video. Something is coming. The VIX is telling you that. Forget what people are saying. The money is telling you that. The money is fearful. 10-year treasury yields are also screaming something is wrong. Don't know what it is, but something is wrong. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. If any updates come out between now and tonight, I will keep you informed here on this channel. So hit that notification bell as well so you can stay informed with what's going on in our markets. Thank you to those of you guys that are now members on the channel that opted yourselves to spend $5 a month, support the channel, help make these videos possible. I greatly appreciate you guys, even though I've never asked for anything in return. Nonetheless, you guys have a great rest of your day, and I will see you in the next one.